I know you thought it was over, but once again, we have just witnessed one of the largest bank failures in history. In fact, this is the second largest bank to ever collapse. And all of this is happening while the office sector could be sending us into a recession. Hi, my name is Austin. I have a degree in finance. In today's episode, we're going to take a look at the recent bank failure, the rapidly declining commercial real estate crisis, and what this all means for you. First Republic Bank seems to be America's next victim. Just over the weekend, the government was looking for bids from the mega banks to buy First Republic because it has officially failed. So what went wrong and why did First Republic Bank fail? Nothing seemed to be a major issue, especially when you have Jim Cramer telling you that First Republic is a good deal, but in reality, things have been falling apart for a while. It all started earlier in the year with the turmoil of the Silicon Valley Bank crisis. And if you're not familiar with the Silicon Valley Bank crisis, it was the 16th largest bank in America and it totally failed. The bank was unfortunately heavily exposed to treasury bonds. Treasury bonds are issued by the government and they're typically seen as one of the safest investments you can make. But the Federal Reserve has also been increasing interest rates, which brings new bonds issued to the bond market. And these bonds are a better deal than the bonds that the banks are currently holding. And since there are better deals out there, the bonds the banks are holding have actually declined in value. Think of it in terms of a car dealership. And let's take the sexiest car of all time, the Kia Soul. So you have the 2023 model of the Kia Soul and it's a great car, you love it, you don't drive it. It's a brand new car, so it has 0 miles on it. Well, the 2024 model just came out and took away all those ugly features from it, and now you have a car that's worth less for the only reason as there's a better option. Since you have the 2023 option, the 2024 is worth more and the 2023 decreases in value. Well, the bond market is similar. The only reason the bonds that the banks are holding are worth less is because there is a better, more attractive option with the new bond. And this is where the major issues come in. Because the bonds have dropped so much in value, the bank has less in the bank than the depositors originally put in it. Meaning that if everyone wanted to get their money out right away, Silicon Valley Bank wouldn't have enough money to do that. You can think of it like a game of musical chairs, and the chairs represent the money that the bank has. Well, there isn't enough chairs for everyone, and someone's gonna be left without a chair. Well, word got out about their issues, and it created a big panic, making hundreds of depositors rushing to the bank, hoping that there's still something left for them. And that's how Silicon Valley Bank failed. But when stuff like this happens, it creates a fear. And they call this fear bank contagion. And this contagion is exactly what happened to First Republic Bank. The First Republic customers saw what was happening to Silicon Valley Bank and they thought, First Republic Bank is a bank that this could happen at too. And well, the rest is history because a lot of people decided to start pulling their money out. The bank didn't necessarily do anything wrong, they just work in an industry that can be very influenced by emotions. And according to First Republic's earnings release, deposits fell by 40%, revealing that customers withdrew more than $100 billion following the collapse of Silicon Valley Bank. And it was even in such a dire state that the government was pressuring 11 different banks into depositing money into First Republic to the tune of $30 billion. Just to keep the bank operational. This was the government stepping in because they knew if they didn't start calming people's nerves that they would have a much worse situation on their hands. Well, unfortunately, despite everyone's best efforts, the bank still failed, making this the second largest bank failure in the history of America, bigger than the collapse of Silicon Valley Bank. The stock is down 97% from the start of all this, and now regulators are stepping in to sell the bank to another bank, and they want to see a smooth transaction from bank to bank. That way customers aren't worried about their funds and they know that their money is in good hands. Really, their only goal is to keep the panic down. This Sunday, they asked different banks to put in their final and best offer, and they would choose the best offer for First Republic. Well, among those banks were PNC, Bank of America, but the winner was chosen. It was Chase Bank, or JP Morgan. And you can also help me win by smashing the like button for the YouTube algorithm. First Republic were unfortunately left with only a few options. They tried to sell themselves, but it really never worked out. Chase CEO noted that the transaction will minimize the cost to the FDIC insurance fund, making it sound nice to alleviate the problems from the taxpayers. Really, this is a case of how the big get bigger. Chase will now be taking over $92 billion of deposits held by First Republic and will not be assuming corporate debt. This basically means that Chase will get to benefit from the best parts of the First Republic Bank without needing to deal with the debts and all the pitfalls that come with the bank. Essentially, this is making this a no-brainer move for JP Morgan. This is just a small drop in the bucket for Chase, but it strengthens their lead as one of the biggest banks, well, actually the biggest bank in America. And some people have been more critical about how mega banks are getting bigger and bigger, but Kevin O'Leary has an interesting take on this.
We're going to see a consolidation of all these tiny little banks into super regionals. maybe we get down to a couple of hundred banks in America.
Essentially now making the point that we don't need all these local banks. Gone are the days of having a close relationship with your banker, and now people just want ease of use. They want phone apps, they want websites, basically anything to keep them from having that face-to-face conversation. And to O'Leary's credit, this has actually been happening since the 80s. They've actually been falling quite rapidly because honestly, it's just easier for you to have a bank fall than to have someone start a new bank. What do you guys think? Are only having a few banks a good thing, or is it a bad thing? This brings us to another issue for small regional banks. It's apparent that economists are concerned about the commercial real estate industry. And commercial real estate, it's a mega industry. It makes up about $20 trillion, but the biggest issue are office buildings and retail buildings. It's no secret that during the pandemic had a tremendous impact on the economy, but in the world of brick and mortar stores, that was particularly hit very hard. The pandemic made people work from home, and it forced people to buy things online because people were concerned about going to the office and getting COVID. This meant stores like Amazon and Shopify and Wayfair, they saw large increases in revenue and did exceptionally well. And during 2020, e-commerce sales increased by 43%, the largest year-over-year increase ever recorded. But this is where the problems begin piling up. This meant people were no longer traveling to the brick and mortar stores. Nick, the president of Siteworks, even said 10 years from now, there will be approximately 150 malls left in the US. So no one wants to go out, no one wants to go shopping, but now no one wants to go to work. In 2019, just under 5% of work was performed at home, but during the pandemic, that shot up to 61%, and now that has settled right around 29% of all work is performed at home. Well, what happened to all those office spaces that people used to work at? The offices, the high-rises, the small business park buildings. Now, so many of them are empty simply because now everyone is trying to work from home. The US office vacancy rate is at 16.7%, which, believe it or not, is higher than the 2008 crisis. And for me, I would totally understand why you would want to work at home. There's so many new freedoms, conveniences, but the banks don't understand that, and the banks, they don't agree with you. This behavior is wreaking havoc on the commercial real estate industry, and some experts warn that this crisis could put us into a very bad recession. So when I think of leaders in the finance space, one of the first people that come to mind is Warren Buffett, but someone you may be less familiar with is Charlie Munger. Munger is a credible source because he is Warren Buffett's vice chairman at Berkshire Hathaway, and he's been spouting off about warnings that the US banks are full of bad commercial property loans. So what does he mean by that, and why are experts warning us about the commercial real estate crisis? The reason this is a big deal is because it once again falls back on the small banks, and these small regional banks hold a majority of the commercial real estate loans. Actually, by a long shot, they hold 80% of all loans for commercial properties. The biggest problem of these commercial properties is they are dropping like rocks. A 22-story tower in San Francisco was worth $300 million in 2019 and is expected to sell for $60 million. Stories like this are popping up all over the place, and this is just hurting the balance sheets of these banks. The banks have loans on these properties, and they are already hurting so much because of the interest rates, but now the value of the buildings are falling below the value of those loans. And when the value of the building is below the outstanding amount on a loan, it's called underwater on the loan. And when companies are underwater on their loan, they lose incentive to pay back on the building. Oftentimes they end up losing money because they just don't have the funds to pay for it. The bank then will receive the property and try to sell it to recoup some of their losses, but it's called a fire sale, and often they end up selling for much less than they're actually worth. But at the end of the day, the bank is left losing out, but particularly the small banks because, well, like I said, they're holding 80% of commercial real estate loans. As commercial office buildings keep coming down in price, it's more likely to bring more pain to small banks, and considering that these offices are already down 25% this year, it seems like we're heading towards the cliff. If you think about how much real estate these banks are holding, but they're also holding a bunch of bonds on their balance sheet, it doesn't make you very confident because the balance sheet must be losing more and more, especially as commercial real estate continues to decline. Chase did an analysis on the commercial banking crisis, and they were looking if this was something to be concerned about. They found that they expect commercial real estate to fall between 10 and 15%, with the worst case scenario being a 40% fall. They went on to claim that commercial real estate, if it were to fall, it would really hurt the regional banks, but it would not cripple them. Personally, I would like to believe them. They have more tools, they have more knowledge than me, but over and over again, it seems like the experts are wrong and we see another crisis unfolding. All I'm saying is it's hard to see in the future, and it's obvious that times are hurting people and banks right now, so to say nothing bad would happen, it's just not super honest. Most likely, if another bank gets in a bad position again, the Fed will step in and make sure everyone's money is safe. They need to make sure that no one's panicking because they need everything to be okay at the end of the day, otherwise another bank run could happen. Either way, I'm torn on this issue. On one hand, recommending using larger banks like Chase or Bank of America, it makes sense, but By recommending people move their money out of the small banks, this actually contributes to the problem. But I would hate to see anyone lose money. So what I'm doing is I'm moving to Chase. I would really like to know though what you guys think about the situation. And if you found this video to be helpful, I would really appreciate the like, and please subscribe. Very small channel, just trying to grow. These videos take a lot of effort, so thank you again, and thank you for watching. And I hope to catch you on the next one.